Before moving into the detailed topic, first and foremost, you need to know that why is Reserve Bank of India issuing these guidelines? Well, the answer is Reserve Bank of India is authorized by the Banking Regulation Act 1949 to issue this guideline, and you need to remember Section 21, Section 35A, and you have to read these two sections along with Section 56. Now, the basic question that may come into your mind is, what are these sections all about? As per the Section 21 of the Banking Regulation Act 1949, the Reserve Bank has the power to control the advances by the banking companies. And in this regard, they consider mainly three factors. Number one, the public interest. Number two, the interest of the depositors. And number three, the banking policy. Now, these three are very important for you to remember. And based upon these factors, they can make certain decisions. And the decisions can be made in the following regards. Number one, they can restrict the purposes for which an advance can be made or may not be made. Number two, that what margin needs to be maintained in respect of the secured advances. Number three, they can put a constraint on the maximum amount of advances or other financial accommodation that a bank can make to a particular company, firm, association of persons, or an individual. And certain factors are considered in this scenario, but for now, just remember this thing. And number four, they can also make clear that how much maximum amount of guarantees that may be given by a banking company. And last of all, they can decide upon the rate of interest and other terms and conditions on which the advances or other financial accommodations are made by the bank, and this is applicable to the guarantees also. As per the Section 35A of the Banking Regulation Act 1949, the Reserve Bank is given the power so that it can give directions to the banks. However, they need to meet certain conditions before giving any such directions. Now, what are these conditions? First and foremost is the public interest. That the direction should be in the public interest, and it should be the interest of the depositors. That is the second condition. Now, the third condition is that the banking policy should be kept in mind while giving these directions. And last but not the least, these directions should be given to secure the proper management of the banking company. If these four conditions are met, then Reserve Bank can give directions to the banking companies. Now, since this priority sector lending guideline is also applicable to the cooperative societies, that's why you need to read this Section 21 and Section 35A along with the Section 56 of the Banking Regulation Act 1949, because the Section 56 deals with the cooperative societies. Now, the next two important questions that may come into your mind is that what are the different institutions which do actually come under this PSL guidelines, and to what extent? The answer to the first question, just remember that the salary earners bank, they do not come under the PSL guideline. Except them, whatever banking companies you can remember in India, they all do come under this PSL guidelines. Now, to understand the targets and the sub-targets which are set under this PSL category, we need to divide the Indian banks into four separate categories. The domestic commercial banks and the foreign banks, which are having more than 20 branches in India, fall under the category 1. The foreign banks, which are having less than 20 number of branches in India, fall under the category 2. And the category 3, which consists of the regional rural bank, and the category 4, which are having the small finance bank in them, are the two most important categories which may be considered for this PSL guideline. Now, to understand the targets are also divided into separate factors. There is a total priority sector target for all the banks in India. There is a segmented target for the agriculture, for the micro enterprise, for the weaker sections of the society. Now, to memorize this table, just remember the data in the highlighted cells. Now, as far as the total priority sector lending target is concerned, only the RRBs and the small finance banks, they have the target of 75% of the adjusted net bank credit, that is ANBC. And for all other banks, that is the domestic commercial banks, the foreign banks with both less than 20 branches and more than 20 branches, they're all having the target of 40% of their ANBC. Now, as for the agriculture and the micro enterprise section is concerned, the targets are 18% and 7.5% for all the banks. So just remember the two numbers. Agriculture is 18 and the micro enterprise is 7.5. And in this regard, just look at the highlighted portion, that 10% of the agriculture credit of the RRBs and the SFBs need to be extended toward the small and the marginal farmers. Now, who are they? I am going to discuss it in some later video. Just remember that out of the 18% of ANBC, the agriculture credit, 10% needs to be extended to the small and the marginal farmers in case of RRB and the SFBs. For the weaker section, the target for all the other banks are 12%, whereas for the RRBs, it is 15% of the ANBC. Foreign banks with less than 20 branches in India, remember they do not have any segmented targets. They only need to maintain a 40% of ANBC as the priority sector lending target.